Today on Forbes, gold stocks are supercharging this forgotten fund. 20 years ago, Wexford, Pennsylvania-based Muhlenkamp Fund was a perennial star on Forbes' annual mutual fund honor roll list. Year after year, it bested the S&P 500, using a low-risk investment formula seeking large and small-cap companies whose return on equity surpassed their price-earnings ratios and whose revenue growth was at least 10% a year. It owned stocks like Ford, Alaska Airlines, and Lockheed Martin. But in the early 2000s, founder Ron Muhlenkamp began loading up on stocks of home builders like NVR and Beazer Homes, which appeared to be great bargains on paper, just as the housing bubble was filling up with irrational exuberance. Fund assets swelled from around $200 million in the late 1990s to more than $3 billion just prior to the financial crisis. That's when Muhlenkamp and other value stock managers hit a wall. The fund's assets plummeted to $1 billion by the end of 2009. Over the next 15 years, an investment in Muhlenkamp Fund would have produced less than 9% per year, while merely owning the increasingly tech-heavy S&P 500 would have produced a 12% annual return. The family fund continued to lose customers, and by 2023, assets were $350 million. Enter Ron's son, Jeffrey Muhlenkamp, who had spent 20 years in the Army and retired as a lieutenant colonel in 2008 before joining his father in the business as an analyst. Jeff, who is 59 years old and who assumed control of his family's namesake fund in 2020, recalls, quote, "Ron's performance was extraordinary, but he ended up staying in those stocks too long and the financial crisis hit." Under Jeff's skillful management, Muhlenkamp has emerged as one of the few actively managed mutual funds to beat the S&P 500 over the past 5 years, with an average annual return of 17.6% versus the S&P's 16.5%. Year to date, the fund is up 14.6%, outpacing the broader index's 13.6% gain. And while Jeff insists his investment philosophy is following in his now 81-year-old father's footsteps, dishing out quotes like, "A good company at a high price is a bad investment," his stock selection reflects a more pragmatic approach in terms of buying stocks that have the market winds at their back. Currently, his mutual fund has 19% of its $400 million in assets in gold stocks, as fears of inflation and geopolitical instability have caused the price of gold to more than double in the last 5 years. For Muhlenkamp Fund, it began as a small position in the SPDR Gold Shares ETF, parentheses GLD, which has since evolved into a large allocation to miners such as Newmont, Agnico Eagle, and Royal Gold. Gold, Muhlenkamp argues, has been the better portfolio hedge than treasuries since COVID. Central banks, he notes, are buying roughly 1,000 metric tons of gold a year, nearly a third of global production, while federal deficits keep widening. He says, quote, "Countries solve debt by devaluing currency. If you want to hide from that, you own gold." With gold up more than 40% this year, does Muhlenkamp worry about a gold bubble? Quite the opposite. Muhlenkamp thinks gold's run could continue for years as debt and deficits weigh on the dollar. He says, quote, "Nobody's buying more gold mines because too many investors got burned by miners last time when prices fell." He notes that miners tend to trade more volatility than the price of gold. He laughs recalling Costco's recent foray into selling gold bars online under its Kirkland label, which only reinforced his bullish conviction. He says, quote, "They sold like hotcakes." Other big momentum-friendly Muhlenkamp holdings include Microsoft, Berkshire Hathaway, and Apple. Muhlenkamp says he has adapted his father's value approach and sees his firm firmly in the camp of converted value investors who buy growth stocks, when the math works. Muhlenkamp starts with screening for above-average return on shareholder equity and keeping an eye on inflation. Jeff Muhlenkamp says, quote, "As inflation goes up, people pay for return on equity. This ROE strategy was a big leg up in the 1970s. Now it's relevant again." For full coverage, check out Sergei Klebnikov's piece on forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.